Hi, everyone. This is Jason Bierk of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest, but I haven't interviewed him in a long time. But I've been following his work for many, many years. I follow him on Twitter. We speak quite frequently. I read his articles, his topics on his blog, and he has one of the top economics blogs for many years now include interest rates, central bank policy, gold, precious metals, jobs, economics reports, typically from an Austrian school economics perspective. He's also had a inflation deflation debate with Peter Schiff many times over the years. Mish Shedlock, thank you for joining me.
Hey, it's a pleasure to be on the show. Well, the debate has been proposed with Peter Schiff many times, but Peter Schiff has backed out every time. And he even did debates that he accepted. Once he found out who he was debating, after he claimed that he would debate anyone, once he found out that it was me, he canceled at least 3 debates. There hasn't been an offer on this, though, for a huge number of years now. So, but anyway, the debate would still be on if he wanted it. And, the debate now would probably be more over in hyperinflation. I think Schiff is back on that kick, and hyperinflation is still not going to happen.
Yeah, I'm in the stagflation camp, so not necessarily hyperinflation because a world reserve currency, historically, like hyperinflation's Mish, and I know you've read financial history, they're from countries that have like war reparations debt in a foreign currency, or it's foreign debt. So it's like dollar denominated debt, like an emerging market. So like Thailand or one of those emerging market countries that has foreign dollar denominated debt and they can't print it.
Yeah, Argentina numerous times, Zimbabwe. Zimbabwe is a slightly different case. That was just pure money printing. But all of these things, there's hyperinflation is really a political event, not a monetary one. And if you look at what happened in Zimbabwe, just real quickly, the government came in, confiscated all the farms, confiscated equipment. We had human flight and capital flight, and that took over. You got Weimar correctly. It was war reparations. And if you look at Argentina, it was taking on debt in a foreign currency. So it's usually one of those 3 things. Oftentimes war is, at the heart of it. And certainly, that goes back to Weimar. But it's really a political event, that causes a disruption of human flight or capital flight. And it just doesn't happen in countries where, those things don't happen, or that debt is denominated in your own currency. And there's recent talk now of the U.S. defaulting, and I just don't get it, Jason. The U.S. is not going to default. And then people say, well, they're defaulting over time by inflation. Well, okay, that's different, but that's not the technical definition of default. The U.S. is not going to stop paying its bills. It's just not.
And we'll talk about this later in the interview, but I think actually the problem now is for the foreign private banks and the foreign holders of dollar-denominated debt outside the United States. So foreign corporations, foreign governments, foreign private banks that are holding these older US Treasury bonds that have all this dollar-denominated debt in the euro-dollar system. Because like you said, the US government, the Federal Reserve Bank, the Treasury, they can create these shadow liquidity programs or bailout programs. They can print the money and pay back the dollar-denominated debt and not have the actual default. But these other foreign entities, they don't have these types of bailouts or liquidity programs in place. They basically have to beg the Federal Reserve Bank for a currency swap line.
It really depends on who has the Treasury debt. When because I keep seeing these reports pop up, Jason, that the banks are in trouble, and I've seen it in numerous places, and we've seen it from Peter Schiff. We've seen it, which I would expect, but we've seen it from places that are from people who were surprising to me. I said, how do how do you not see this? The Fed stepped in with a program that is, well, first off, some background. The Fed drove interest rates down to roughly zero. You had all these US banks and other entities load up on long duration treasuries that were maybe at 1% or so when the short-term bond rates were at zero. And they did it because the Fed gave a signal, actually. So the root of a lot of this problem stems from the Fed. So they loaded up on these long duration treasuries on the belief that interest rates would stay low forever. Now, that was a really bad bet. And these banks are just hugely, enormously underwater on these treasuries, down on long dated treasuries. They're down 50% on some of their holdings. So, the question arose then, are these banks insolvent? Are they going to go under? And no, they're not from this anyway. And the reason is the Fed came out with, swap lines, and the Fed is swapping these things at par with no discount, no haircut on these things, even though they're 50% underwater on some of these, or 30%, whatever it is. It depends on the duration of the treasury that they bought. Swapping them with assets on par. So they're just going to hold them to maturity. They're never going to have a realized loss on any of this stuff. So, we can agree or disagree with whether or not the Fed should do that, but the Fed did do that. And that's the political reality, that these banks are not going to get in trouble over this. However, what is going to get the banks in trouble, and some of them probably seriously in trouble right now, is commercial real estate, because these losses are real. People are walking away from commercial real estate, handing back the keys to the bank, saying, "Well, I don't want to make this interest rate payment anymore. So here, you can have your property." These are realized losses that the Fed cannot paper over. So commercial real estate, not residential, is, where the problems are. So this is totally unlike 2007, 2008, 2009, when people were, handing over their keys, saying, "Here, take my mortgage. I don't want it. Take the house. I don't want it. You can have it." Banks had realized losses there. So the Fed came out with a whole bunch of alphabet soup, programs, TARP, TALF, I don't even remember all of them, to bail out the banks back then. This is a little bit different because, this is commercial real estate, and the Fed can't paper over this one like they did before. So we'll see where the fallout comes, but it's going to be over commercial industrial loans, not residential, as was the big problem in 2007, 2008.
Or you said US Treasuries, because the US Treasury created the BTFP, another shadow liquidity program. And it's very similar playbook, Mish, to the 2019 repo crisis, because a lot of people might not remember this. I mean, the rules were constantly changing every couple of days with the repo crisis. I mean, I think initially the loans were at par for a week, and then they kept getting extended and the rules kept getting changed. And within, I think, 3 months, the Fed's official balance sheet had grown by $1 trillion. So we could see something similar. But like you said, they're going to make sure that a lot of those banks don't take the losses on the treasury bonds. The Fed can basically buy them. It's the rest of the loan book with interest rates and the lag effect that I think is the problem for a lot of these regional
Exactly.
banks.
And by the way, it's not just treasuries, but treasuries and agencies. In other words, mortgages. Mortgages. People aren't going to be walking away from their homes, even though the banks, if they held this, the banks aren't holding as much residential as they did. They've pretty much walked away from the business. But since no one's going to walk away from their home because they've got huge amount of equity in it, although banks are just getting clobbered on the actual technical value of these assets they're holding, they're not going to get in trouble over it, except in one general sense here. The banks know they have losses. They understand their capital impaired. So what does that mean? They're not going to ever realize those losses, but they are impaired, and they understand that's going to have the impact of curtailing any additional lending. I mean, they're afraid to make loans now, without getting a higher interest rate for their money. So it's going to slow down credit growth, which is important, but we're not going to see defaults over it.
And we're recording this interview on Wednesday, November 15th, 2023. For our listeners out there, the dollar index is down a little bit to 104.4. I want to get your thoughts on the real economy, though, because you talked about credit growth. We're in a higher interest rate environment. The Fed hasn't cut rates yet, like a lot of people were expecting. Do you think that the lag effects on the real economy are finally starting to kick in here? We're starting to see a lot of problems now for the consumer, people who aren't super affluent, making hundreds of thousands of dollars or $500,000 a year more. The people who are exposed to high interest rate debt, small business loans, car loans, are they starting to have real pain and defaults now?
Well, we're seeing it. We're seeing default rates up in the last month, in the last quarter, excuse me. 90-day delinquencies on credit card debt jumped 2 full percentage points in one quarter. Now, that's pretty huge. And I don't have any numbers, but precise numbers, but we're seeing the same thing with auto loans. Danielle DiMartino Booth, who I follow, talks about some of this stuff, all the time. And, she's mentioned some specific sectors that are just in trouble. And so it's starting, but, how significant is it? It's not yet, I don't think. But we've been seeing these signs of stress for some time, and they haven't mattered yet, but they will. What the Fed sees is a consumer that's still spending, although in real times, not as much as the report that came out today would suggest. Or last month in particular, there was a huge jump in retail spending, and it was slightly negative this month. But in real terms, year over year, consumer retail spending has fallen for 10 out of the last 12 months. I commented on that today. So although spending looks strong, it's mainly a mirage, due to inflation. But if you look at I have not looked at the GDP Now forecast today. I wish I did, in light of a couple of the recent reports. But the last time I looked, it was at 2%, and for most of last quarter, it was around 5%, and we came in pretty near that number. So the economy looks strong, but are the numbers real? Which set of numbers do you believe? And GDP has been strong, but gross domestic income hasn't, and the two numbers are supposed to match. So when this eventually gets revised away, is income going to go up, or is GDP going to go down? I think it's mostly the latter, but it would have to drop a lot for there to have been at least a recession that's going to call. But if you look at the income numbers, we've been in or close to recession now for about 4 quarters in a row. So you've got this tale of two economies here that's quite hard to decipher properly. And the same thing is going on with the jobs market. We have jobs numbers month over month after month that look at least reasonably strong, and some of them very strong. But if you look at employment versus jobs, employment's barely budging at all, and most of it's part-time. So which one of those sets of reports is right? And here I'm once again, the gross domestic income seems to be matching, that it's mainly part-time work, not full-time work. So, but there's two sets of numbers, so you can literally get any view you want here. I would just caution that because of all these divergences, things probably are not as strong as they seem on the surface, because mainstream media focuses on jobs, not employment, and it looks at gross domestic product rather than gross domestic income. If you look if you combine the two, or look at the numbers that I think are more accurate, income and employment rather than jobs and GDP, we're flirting with recession and happening.
Well, hasn't the household survey, and I just heard Jeff Gunlock talk about this, it's saying that people are losing their jobs. And in the jobs reports, 1, 2, 3 months later, they've been revised downwards like clockwork by 50% a couple 1 to 3 months later after the jobs report. So the headline number, the algorithm straight off the headline number, and then a month, 2 months, 3 months later, the real jobs number is by the Bureau of Labor Statistics is revised downwards by 50%. So I think there's red flags there.
Not by 50%. I think I don't know what the numbers are. Zero Hedge commented, but I didn't read the article. I think he said jobs have been revised lower 8 months in a row. Certainly not by 50%, because those numbers would show up in things. It would just show up in the charts. But yeah, they've been taking away 10,000 here, 20,000 there, because I do post the revisions every month, and I just didn't notice how many months in a row it's been going on. But it's not as dramatic as 50%, but it has been going down every month for a while. And that's another thing, in these in weakening economies, as you're heading in towards recession, the revisions tend to be negative. But we've seen some positive revisions lately that kind of surprised me. Just even today, we had one. They revised retail sales for last month higher. And but when you look at the housing things, almost all of those are lower every month. It's almost like a joke of a report on these housing starts and housing sales report revised lower every month. Same thing. So it's another sign. But if you still look at it, unless you have a lot of faith in that gross domestic income number, we're not close to recession. If you do have a lot of faith in it, we're in it or close, and that makes it very difficult, and I get laughed at all the time. Mish, where's your recession? Well, I don't know. To me, it's possible we went in one and are now out of it. That's how confusing a lot of these stats are.
I think it's unlikely that we went in a recession or out of it. I mean, I think the real economy, Mish, is bifurcated. I think a lot of people who aren't making a couple $100,000 a year, who are exposed to high interest rate debt, they're worried about their jobs. We're just seeing in the headlines, a lot of companies, whether it's tech companies, small businesses, banks, they're firing like crazy. What wasn't the majority of the jobs report, the jobs creation wasn't like over 30% of the jobs created. It's been government jobs.
Not 30%. But I think the last number was, actually it was. I think 50,000 jobs were government jobs in the last jobs report. But that was and the month before, I think there was a pretty big percentage. I don't know what it was, or certainly a pretty big number of government jobs. But the case for going in recession and dropping back out of it is, depends on, looking on gross domestic income. Now, the Philadelphia Fed has I'm trying to remember what they call it, but it's GDP plus. and it's a not an average of GDP and GDI, but some sort of weighted, component that leans way more heavily on gross domestic income. And it went negative 2 quarters in a row. And actually, I took this all the way back to something like 1962 or something. And we've never seen an instance where GDP plus went negative for even 1 quarter where we didn't have where the economy wasn't in recession or went in recession within a quarter. And so maybe it was 2 quarters. But the case that we went in recession and came out was the GDP plus GDI, if you take it, but their revised GDI, went pretty deeply negative and then went positive. So to me, it's possible. Now, will the NBER, the National Bureau of Economic Research, that's the official arbiter of recessions, will they, declare a recession on that? Probably not. But it's quite possible we did go in one and came out. And it's actually happened before. I don't remember what year it was, but the NBER did not call for a recession until after it was over. It's possible we see something like that again, or we see, a double dip, and it's going to be up to the NBER to determine these things. I mean, they officially get to decide, not the Philadelphia Fed GDP plus measure. But if I go back through history and look at the numbers that come out of these things, I mean, they're on target. But like everything else, it gets revised. And so we don't know if there's going to be revisions coming up to these to this GDP plus model, and if so, and in which direction. They can very easily, revise their numbers away. They have, if you go back and look at them, they're heavily revised. Their final numbers match recession. Great. So the question is, are the numbers today any good or not? And I can tell you they're not any good, but which way are they off?
Well, the consumer is consuming, like you said, but are they consuming with savings and job growth and higher incomes? Maybe in some industries with a government forced higher minimum wage law or something, or a union renegotiated a contract with the United Auto Workers or airplane pilots. But I would argue that a lot of the consumers are still consuming with credit card debt or high interest debt, or they're refinancing what there's a big spike now. People are refinancing. They're rolling over the credit card debt into home equity loans, I think.
Yeah, they wouldn't refinance their home because they're not going to do 3% for 8. You have to be, seriously in trouble or nuts or both to do that. But people are, taking out, home equity lines, and they're a pretty nasty percentage. And certainly credit card defaults or delinquencies are rising up, 2 full percentage points. So there are all of those signs here now. And I think auto repossessions are up. And, but we've got 2 different economies here. And this is another thing that makes it hard is we have all the people who already own their home, existing homeowners. And when the Fed slashed interest rates to 0, the mortgage rates dropped down to actually below 3%, and for a really long period of time. So anyone who had an existing home was able to refinance at 3%. If you have a 5% mortgage and you refinance 3%, that's extra money that you did not count on every month, since they refinanced. That is one of the things that's supporting spending here. no question about it. And I've hardly seen anyone to talk about this. But for the 36% of the people who rent their home, their rent payment has gone up 27 consecutive months, at least 0.4% for 27 consecutive months. Now, it doesn't happen every month like that. It happens big bang once a year when they renew their lease. And people have been telling me for about a year now, maybe even 2 years, that the price of rent is falling or soon will. And for 2 years, I've been saying, no, it hasn't. And I don't know if it will. And I've been right on that,
I
because
think I'm in
what's
your camp.
happening is existing leases keep rising. It's only the new leases that have been coming down, and that's a pretty tiny percentage of leases. So here we have 36% of the economy that rents, unless they have a really, really good job whose wages have kept up with inflation, they're in trouble. And I think that explains the polling numbers out here. If you look on the political side of thing, Biden says the economy is strong, it's booming, jobs have never been stronger, blah, 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 blah. Well, guess what? If you rent and are living paycheck to paycheck, the price of food is another thing that's gone up. Like I just reported on this the other day. I think it's on average 0.6% every month for something like 30 months. I don't remember the exact number of months. So for those 36% of the people who are renting and buying food, the other people, the people who refinanced their house at 3% when they were paying 5 or 6%, they can cover that. They don't like it, but they can at least cover that expense. Other people can't. And rising prices in general have put people in a very sour mood. And I noted I've wrote about this 3 times recently. The Wall Street Journal finally picked up on it, because just today they came out and were commenting on the prices of homes and the price of rent and the price of food. So, they finally caught on to something that I've been talking about for a really long time.
It sounds like you're describing stagflation and shrinkflation, although not necessarily the high levels of stagflation we had 12, 18 months ago, but still stagflation. I mean, it's not like 1% inflation. I mean, serious from what you described with the food prices, and the CPI is not accounting for any shrinkflation that the restaurant or the grocery store is doing. The other part of this, you said with rents, I look at it from a tax component, Mish, and the governments don't want to cut back. The governments are like in a case with the home prices still relatively high, the governments are saying we want to raise property taxes. And that's been a trend where there's been big property tax increases, especially in the last couple of years. Yeah,
they raise property taxes, and guess what? If and when prices come down, they don't lower them, do they?
Well, but the average person though doesn't understand though that if you're a property owner and they raise your property taxes, you're not going to cut your rent. I mean, because then if you're a rental property owner, the math doesn't work.
Yeah, exactly. It's only and the reason why I wonder. I mean, people have been talking. Even some people I respect, keep posting that rent prices are coming down, and I keep saying, "Show me where," and I don't get any answers. And they say, "Well, okay, well, rent's falling in Austin." Okay, well, is Austin the country? And are rents really falling in Austin? I don't know. I certainly believe with all the construction that's gone on in Austin that the price of new leases is coming down. They keep dropping the rents, but is a homeowner that's renting out to an existing tenant, until people start moving, and moving is a real hassle. There's just a reason why rent is sticky. So, okay, someone's moving in, new, their first lease, you can raise the rent. But, let's say the price of rent, does start come down. If the rent comes down, $50 a month or $100, is that, worth the hassle for you to actually move? So,
Definitely
I don't
not, because
know.
it's
From
very
my
expensive.
perspective, no. But if it was substantial enough, not just $50, because it costs you $500 to move. So
That's a low
the
estimate. I mean, normally it's way more. It depends how much stuff you have, but it could be thousands of dollars now. It's not cheap. Depends though.
yeah, so right, so rent would have to come down a lot relative to to make it worthwhile for someone to actually move to get a lower price. Rent is just existing leases for people who don't move is pretty sticky. Now, the best we can hope for is they stop rising as much. But I'm wondering, one of the things that the Fed has done here, with mortgage rates now, well, they topped 8% for a few days. I just did check this today, down to about 7.5%. That's just enough to kill housing. No one's going to, trade their 3% mortgage for a 7.5% one. But the other thing it did is it's stopping slowing of new construction. So if we halt the flow, if we halt construction, new construction, that's going to curtail supply here. So everyone's talking about, well, wait, we do have record numbers or near record numbers of homes under construction, and it's every year, every month for a year. You just wait till these things get completed and rents are going to start falling. Well, okay, is that new rents or is that existing rents? And meanwhile, a lot of multi-family housing is slowing, pretty dramatically here now on new construction. Who wants to construct a new building at 7.5% rate? So they're not.
Yeah. Plus, the home builders are, I think, subsidizing by 200 or 300 basis points. These are the publicly traded ones, not the smaller ones. They're subsidizing so they can get those new homes that are under construction off their books, off the clear inventory. So they're actually like buying enormous amounts of points on mortgages. So the new home buyers will buy those homes that are under construction. So that's
absolutely. Absolutely, Jason. And then the question is, what are you getting for your home? So they keep reporting that median home prices are falling. Okay, median home price of new homes is falling. But what are you getting? The builders are, to make things quote affordable unquote. Builders are cutting back on lot sizes. They're cutting back on the number of rooms. Maybe you get a 2-bedroom house instead of 3, or a 3-bedroom house instead of 4 for the same price. The granite is gone and is replaced by some, fake granite or something. Maybe
so it's
a cheaper
substitution.
floor instead of tile. You get the idea here. The median prices are dropping, but what you get for the price you're paying is dropping as well. So it's not an apples to apples comparison. If you look at Case-Shiller resales of home prices, and I was actually surprised when this first started happening, but I understand why it's happening now, is the price of existing homes keep rising. So mortgages are getting more and more and more unaffordable. And I've crunched some numbers on these. It's like staggering. The monthly payments have doubled just from the same house that you could have bought 2 or 3 years ago. So it's no wonder that no one wants to sell their home. This
Well,
is what the Fed did when they launched that QE program. And I discussed it in real time at the time. And now the chickens are coming home to roost. The Fed created this housing bubble, and they don't really admit it. And it's going to take a long time for this to unwind. So, and the higher that mortgage rates stay, above 7, for the longer the mortgage rates stay above 7%, the longer the housing is going to be in serious trouble, and the longer the divergence between the haves and the have-nots is going to continue. And so a third of the nation has been literally screwed, the renters, over what the Fed did.
well, also my generation or younger, so younger adults that graduated college recently or in the last 10 or 15 years, they don't have the 20% down payment, and they might not even be able to get approved for an 8% mortgage with their proof of income at these interest rates. And the home prices have not fallen. So I mean, like, a lot of people, even if they wanted to buy a home, they couldn't get the 20% down payment, and then they couldn't get approved for a mortgage at these rates.
Yeah, politically speaking, that's one of the key reasons why people are mad. The there's no solution here for the Fed, because if they lower interest rates, they're just going to create an even bigger housing bubble. So I don't see the escape here for the Fed. And what it means is this portion of the economy is going to be weak for many, many years to come.
Well, it's also a similar problem to China, and their home price bubble now is okay. Xi Jinping has said he wants to lower home prices for younger adults to start families. The problem is their entire banking system was built off higher home prices as collateral. And in this case here in the United States, higher home prices, that means then all these state and local governments, municipalities, they were raising property taxes all along the way. So like people, every time, I don't know about where you live, but where I live, every time there's a new home built with older homes around it, they reappraise all the older homes, and the home value goes up and the property taxes increase. So this is like how the government has benefited from the Fed inflating the home prices. The property taxes correspondingly go up with the home appraisal costs. So I don't see them allowing the home prices with free market forces and deflation to stay low for a long period of time, because then the taxes that these state and local governments were relying on, with property taxes and planning increases every few years or something like that, those would all go away, and then the government budgets would be a mess.
Yeah, and the governments are never going to voluntarily lower assess stuff lower en masse. It's up to the individual to protest. And I'm very familiar with the property tax situation, having lived in Illinois. On a $400,000 home, we had $15,000 in taxes. In Illinois,
that's shocking.
You don't own your house. You rent it from the government. $15,000 a year in property taxes on a $400,000 home is crazy. And but
they're probably still.
And then at the end of the house, the home price didn't even appreciate at all. In fact, unlike elsewhere, and it's one of the things that high property taxes do in states like Illinois, is we didn't even get any appreciation out of it over 15 years. Crazy.
Well, you have a lot of people that either don't want to move to that state, or they don't want to stay in the state, so they'll sell their homes. So there's more selling pressure. The demand to buy the homes is not there. I remember Detroit at one point, when Detroit collapsed, their property taxes were so high, they were giving away downtown real estate, their residential stuff. It was super cheap. It was literally pennies, because the property taxes were that high. So no one wanted to go in there and buy it for a long time.
Yeah, and crime enters the picture here too. It's just a real mess, especially in California, with what's going on with gangs, walking into stores, carting off mass amounts of merchandise. So if we want to understand why, another reason why people are upset, just look at crime and what people are getting away with. And also I think, a lot of people look at the problems we have here in the US and say, okay, why are we giving so much money to Israel? Why are we giving so much money to Ukraine? Why are we just giving away so much foreign aid in general? So, there's lots of reasons here for people to be angry, and it was like my hoot of the day, Biden complained last month. He said, the people, it's all the media that people only hear negative reports about the economy. I went out and just did a post, how good is the economy, and Bloomberg, the Wall Street Journal, the New York Times, the Financial Times, Axios, everywhere, I just huge amounts of press on how great the economy is, how we're heading for a soft landing, how there's no recession. It's just 180 degrees opposite what Biden proposed for people being in a sour mood, because there's nothing but glowing praise in even conservative media about how great the economy is. So,
well, I mean, people are talking about inflation in their bills and stuff like that, Mish. So I think some people are starting. That's the number one polling issue you said for elections and stuff. People are talking about inflation in the economy right now, or at least the average person is, because if you're not making hundreds of thousands of dollars a year and you have high interest rate debt, I mean, you're exposed to a lot of problems in the economy, especially with a certain amount of stagflation and shrinkflation. You talked about the foreign aid, Mish. I mean, that's like textbook Cantillon effect, because rationally, the voters should say, well, they should be investing the money here in the United States economy. We need to improve our infrastructure, invest in our own economy. But that's not how things work here in the DC metro area. I mean, at the military industrial complex, the vice presidents at Lockheed Martin, the vice presidents at Lockheed Martin, they need another Porsche, another luxury condo here in the Reston Town Center or somewhere like that. And then they need to park a sugar baby there.
I think a lot of this actually is if people can see through the lie, it's going to impact you. So, but Biden comes out there and said, well, this is the greatest economy ever. Made that statement. This is the greatest jobs market ever. Okay. Now, when people go in the grocery store and buy something and they try and buy a home and they can't, and they're struggling with rent and they're struggling with food, it's the lies. If he would, say, okay, well, inflation is high and, we hope to deal with it. But if all you have is lies and platitudes, eventually people get tired of it. And one of the things in the poll that I'm referencing, and it was another poll that can, but the first one was the New York Times Siena poll, and it was people in their 30s and younger who are the most mad. And I said, you know what? This makes perfect sense, because these are the people who want to buy a home, want to start a family, and can't. So, it all adds up. And like I said, the Wall Street Journal, just caught on to this with an article about things that I've been discussing, on my blog for many months.
So I want to transition now to the bond market, bear market, U.S. government finances, inflation and deflation. They're all kind of related here. What type of damage do you think would happen to the banks and foreign holders of U.S. Treasuries if this U.S. Treasury bond bear market lasts for years longer?
One thing that we can say is we have a record amount of interest on national debt that we're paying here now with the rising interest rates. We are, what's the total debt now? 32, 33 trillion. It's
almost
rises.
34.
34. Okay. See, I'm behind the times.
It increased by $1 trillion, I think, in like 4 months, something like that.
Yeah. I was just trying to remember from what to what. Was it 32 to 33 or 33 to 34? And I've not had time to comment on this, but the Wall Street Journal had an interesting article the other day. How, and this is global interest on global government debt is well over $1 trillion. It was like $1.5 trillion. Maybe it was 2 trillion. These numbers just keep rising and you keep forgetting them. But, that's a lot of money, trillions of dollars, just to service interest on the debt globally. That's what's happening. And, so that means that globally, governments either need to raise taxes more or spend less, or they just keep spending along the same path, which is another supporting factor here for why inflation is going to stay higher longer than anyone thinks. So, when does it blow up? Because, in my head, it seems like it has to somewhere. But that's a real big issue here. The Fed desperately now, actually, it's so funny. I mean, for 5 years, the Fed, said that low inflation was the problem of our time. Well, and that if we ever got to inflation, they would know how to deal with it. Well, they haven't, have they?
Well, I didn't believe them back then. I didn't believe them back then. Especially Janet Yellen.
Bonds are a real problem here because of trillions of dollars that globally now has to finance the debt instead of financing something else.
So you think then that bonds in a deflation scenario, so let's say the Fed keeps rates at these levels, there's bankruptcies, not necessarily bankruptcies here in the United States of banks, but maybe say banks in Europe or banks in Canada. I'm hearing just crazy stories about how bad some of those banks are. Let's say that happens then, and there's losses on the bonds, and we do have deflation. What do you think would be the Fed's response to a deflationary scenario then?
Well, they would just, lower interest rates. And, a lot of the problem here, deflation is not a problem. Deflation per se is not a problem. And I've talked about this probably 30 times. I keep referring back to, an article that I wrote regarding the BIS, the Bank of International Settlements. Made one of the best articles I've ever written on the subject of inflation and deflation. They went back and looked at all the periods of deflation in history, and they determined that deflation was not a problem, and in fact, it was a benefit. The reason why deflation, and yet people seem to think, they believe this mantra that deflation is bad. It's not bad. Let's just discuss it from this aspect. Deflation means the price of goods is as they, we're talking about price deflation here, not credit deflation. That the price of goods is falling. So what does that mean? That means you get more goods for your money by definition. And since you get more goods for your money, standards of living increase, not just for the wealthy, but for everyone. The natural state of affairs actually is deflation because we have rising productivity. We have all the achievements. Instead of 90% of the economy farming, we have people doing other things because of farm equipment because of, automobiles are better. We have better transportation. We can get from here to there faster, saving time and money. And with that, the price of these goods and services, tends to fall. The Fed doesn't like that. Central banks don't like that. So they try and force the prices up, and they succeeded in spades this time. But anyway, the Biz article actually mentioned all of these things and said, that price deflation was actually a benefit, and it was for the reasons that to me are obvious. Getting more for your money is better than getting less for your money, and everyone wants to get more for their money. The problem comes in when banks make loans on assets like commercial real estate or housing or farm equipment or whatever, and the prices of those things, of the assets on which banks made loans drops, guess what? People walk away and they say, oh, here, take your property. It's happening right now in commercial real estate. Prices on a lot of office space have dropped 50%. So the falling price is not the problem. That's a good thing. The problem is banks made loans based off of these assets, and the banks suffer. So what we really have is not that inflation is good for people, because it's not. It's inflation is good, and you don't hear it phrased this way ever. In fact, it's the first time, actually I've said this before, I'm sorry, is that inflation is good for those who have first access to money. That's the banks and the already wealthy, who benefit from, rising asset values. And but if the banks keep lending more and more money off of the houses, off the commercial real estate, off of, whatever property, commercial and industrial loans, and those prices start to fall, well, the banks get in trouble. And so really, inflation is good for banks. Inflation is bad for people. But, we don't ever hear the Fed say inflation is bad for people. They want this 2% inflation as if, 2% is some sort of magic number that they can't even defend. So, that's where this idea that inflation is bad comes from. It's the Fed promoting, nonsense, because they need to prop up asset values off which banks made loans. Well, you know what? It's bad for everyone else. And the Biz realizes, and the average person that walks into the grocery store who would rather have, 2 pounds of cheese for their $10 rather than one, feels the same way. But it's so pounded, the media even buys it. Oh, and deflation is bad, deflation is bad, deflation is bad. No, it's not bad. Deflation is a good thing. Yeah, but it will destroy the banks who are over leveraged in loans. So what's the problem here? The problem is banks over leveraging in loans.
Well, also inflation benefits the government, the US federal government, who's the world's largest debtor. So they want a certain amount of inflation, not too much inflation, so most people wake up, but enough inflation to where the debt is inflated away in real terms. So like they can pay nominal Social Security payments that are not inflation adjusted with the cost of living adjustments. But like you said, the financial history is very clear. The Bank of International Settlements actually acknowledged it. I'm surprised. Free markets produce beneficial deflation for savers. That's capital accumulation. So like all that investment, the new technology, the productivity gains, that's beneficial to savers. It's not beneficial to debtors, though.
Right. And so, once again, we're back in this massively divergent economy here between, the asset holders and the non-asset holders. And inflation is really crippling those that don't have assets, those that don't own their own house.
or can't grow their income to offset inflation, then their standard of
Correct.
living is going to get crippled at high interest rates, high taxes, and stagflation and shrinkflation.
Yeah.
So it sounds like a very difficult environment, Mish, because of the government debt. Do you think then it's going to be similar to the 1940s or 1970s, or do you think there's going to be a lot of differences then between how government decide to deal with this total debt load?
It seems pretty much like a stagflationary environment to me. And, if long-term readers know, I was in the deflation camp for a really long time, and we might see credit deflation again. And but I several years ago, I threw away my deflation hat, and that was the correct view. We had credit deflation. The Fed essentially overwon, won that. We might see one more round here, but the Fed is afraid now, and rightfully so, and of lowering, interest rates, even when, and there's going to be another credit crisis of some, prop up its head. It's guaranteed with all the imbalances we have here. But out of fear of stirring up what they've caused, they're going to be reluctant to reduce rates as much as they have in the past to these crises. And the other thing that's important to note here is that for 3, maybe even 4 decades, we had global wage arbitrage. So jobs, manufacturing left the United States for China. The wages overseas fell, keeping a lid on prices. The amount of imports coming from China, Vietnam, everywhere, literally, kept a hold on prices. Well, and we also had just-in-time manufacturing. No one ordered any part, any component, before it was ready. So all of those things have vanished here. The Fed no longer has a gale of global wage arbitrage at their back, allowing them to try and inflate at will. Instead, we have supply shortages. We have boomers retiring. We have more need for more healthcare expenses here in the United States. We have pressure on Medicare. We have Social Security, which is actually price adjusted, so higher payments coming out there. All of these forces here, and actually declining productivity due to boomer retirement. To someone who's age 62, 65, whatever, is now just retiring, taking all their skills away. They're replaced by someone in their 20s or 30s with a lower skill. They can't get as much done. And of course, people are demanding more time off here now. More, work at home, more healthcare, more, they're demanding more. All of these things are adding to the inflation outlook. I'm pretty confident, and I actually wrote this a couple of years ago, that the decades-long, the secular bull market in bonds is over. When the 30-year long bond hit 1, actually, I think it dropped just below it. That it dropped to 0.99%. When it dropped that low, I said, "This is it. It's not going to get any better." And that's when I threw away my deflation hat. At that time. Now we can, if banks get seriously in trouble, the Fed will do whatever it takes to save them. That is a given. Until that happens here now, the Fed is going to be really reluctant to start cutting rates very fast. And because of all the forces that I mentioned, we have the extra money in people's pockets from the 64% of the people who do have a mortgage and refinance, and the union salaries going up, and productivity declining because we have more part-time work. All of those things are going to keep the inflationary pressures high, going to reduce real growth. And the economy to me is in trouble, and the stock market does not reflect that yet. It's almost unconscious, to me, how the stock market is reacting to some of this stuff, but you can't fight it.
Well, it's kind of a mini dollar milkshake too. So there's deglobalization as well. So you have China losing manufacturing jobs to Mexico and other countries. So there's some deglobalization, and the trend is starting to accelerate there. That's going to put higher costs into supply chains. If the energy prices stay relatively high or go higher, that's going to put higher costs into input costs for manufacturing, small business owners, supply chains. So it's not just the Fed, keeping interest rates high or the inflation system. I mean, I could see other things with wages and energy costs, all these inputs. This definitely looks like, a stagflation or stagflation in waves similar to the 70s.
Yeah, wages are going. I don't think it'll be quite as severe, but wages are going up everywhere. They're going up in China, and China's losing jobs to Vietnam. Yeah, the one thing Trump bragged about was I've picked on Biden enough, and good reason, but Trump started a lot of trade wars with China on grounds that trade wars are good and easy to win. Well, he proved that trade wars are not good and they're not easy to win. He didn't win any trade wars, and so our trade deficit with China shrunk a bit, but it went up with Mexico, and it soared with Vietnam, and it soared with Taiwan. And so, all we got out of it was a shift in imports. Instead of getting them from China, we're getting them from, Mexico or Vietnam instead. Now, maybe there's some good in that, it's good to not be so dependent on China. But all it did was increase our dependence elsewhere. It didn't really solve anything. And, Biden has this idea that we're going to bring all of these jobs back to the U.S. Well, and his $7,005 tax credit for an EV, people still don't want to buy them because we don't have the infrastructure yet to charge them. And if everyone did, I truly wonder, what the cost of these batteries that go into these cars would be, because I don't think the supply of minerals is there either. And
we don't have the electrical grid either. The electrical grid couldn't handle everyone charging.
Right. The electrical grids, I talked in one of my posts about the transformers. So it's just disastrous policy here over something that's, I believe, very debatable. And even if you don't think climate change is debatable, one thing I'm quite positive that is not debatable is expecting government to do anything sensible about it, even if it is a problem, is a huge mistake. Biden supported all the wind energy, which is not reliable at all. This offshore wind energy is killing whales of all things, and now manufacturers are backing out of all these projects because they were these wind projects and some of these solar projects were only viable at low interest rates with a subsidy on top of it. And now we don't have low interest rates. And so all these people that promised, okay, well, we're going to supply you this wind, electricity at a cheaper rate than you're getting now. Guess what? Now they're demanding they're either saying they're going to drop out of these projects and cut their losses, or they want to hike rates more than they would have from the existing plants. And one thing that's not talked about a lot, and in fact, I don't even think I've mentioned it on my blog, but it just popped into my head here now, is we're spending all of this money for what? Not for new goods or services, not for increased productivity, but we're going to take energy that we already have, and we're going to say, well, we're not going to have that energy anymore, but we're not going to have any additional energy. We're just going to replace that energy with something else at trillions of dollars worth of costs. All we're doing is trading A for B, the equivalent thing. It's electricity coming into your home. It's not your appliance is going to react to the same way, over it. But we're spending trillions of dollars just to stay in the same place.
Well, not even in California, they have blackouts and brownouts with solar and wind.
Yeah,
so they're
exactly.
not even affected. It's not even. I would argue that the return on investment for a lot of these ESG projects, solar, wind, biofuels, we're seeing this in Germany. Did you see in Germany, the German government just had to do bailouts for all of Siemens for their solar and wind division. So they lost enough money to where those divisions went bankrupt and needed bailouts.
Yeah, and Germany 4 years ago was getting 28% of their energy from coal. Now, because they scrapped all the nuclear plants and supply of natural gas is limited, they're getting something like 31 or 32% of their energy from coal. So they've actually gone backwards here now. And both in the EU and the United States, we're starting to see a little bit of revolt here, against these policies, because, rates are going up. And we're spending all this money on wind and solar. And think about it from the point of view, the guy's struggling to put food on his table, and we're giving all these subsidies to produce wind energy. And then we tell them, oh, well, your electricity rate's going to go up because we spent all this money on wind. Politically, that doesn't work, and it's starting to bite.
Well, look at the small business owner surveys. I mean, they're dealing with much higher interest rates and cost of capital. The consumers that they cater to might not be spending as much if they don't have discretionary income. Then on top of that, their energy costs are going up. So all these costs for a lot of small business owners, they're up across the board. That just sounds like a nightmare in a stagflationary environment. Yeah,
we've not seen the worst of the energy fiasco over this yet, and it is very damaging. Right now, the U.S. is energy, pretty much independent, but we've cut back on the amount of oil and natural gas and whatever we're delivering. And if we replace that with stuff that's not reliable before the technology is even there, how do you get wind energy from offshore to Chicago or Southern Illinois or whatever, and you're not. How do you get the solar energy from the deserts around Phoenix, to North Carolina or wherever? You're not. The grid isn't there, so you have all of these forces in play. We've set upon something, and we've not even fully explored all the costs that on purpose, by the way, to make these projects worse. Because if they told you what this would really cost, no one would want to pay for it.
Well, that's why Congress sneaks stuff into bills. That's why bills that are passed that have nothing, so like the Inflation Reduction Act, I mean, there's a lot of green energy spending hidden in there, trillions of dollars hidden.
Oh, that's what it's all about. And they even reneged on some of the promises that they made to Joe Biden, over it. It's really a travesty that bill passed. And if Manchin would have just, held his ground, it wouldn't have.
Well, all these bills are a disaster, honestly, Mish. I mean, the lobbyists write the bills. There's the people in Congress in both houses are trading their votes for favors or side deals or whatever pet project they have. I mean, and then a lot of the people in Congress are doing insider stock trades to make extra millions of dollars or rezoning land so that's how they get rich quick. The whole system here in the DC metro area, there's just so much corruption. It's tough for the average person to comprehend.
I think we need to wrap this up here. Are there any final things you want to go over?
No, Mish, I really enjoyed our conversation. So it sounds like you see a lot of same things to me that with all the bad policy decisions from Congress and the Fed and the other central banks and the debt problem, sounds like a lot of stagflation is coming for the average person.
I think so. We might have one more bout of deflation first, and it'll be credit deflation. It will be because people are walking away from commercial real estate. It'll be things like that. I don't think it will last long. I think the tailwinds for inflation will easily overcome this. And of course, if we do see, that next round here of credit deflation, if banks really get in trouble, guaranteed the Fed is going to do what it always does, and that's try and protect them. And it's not letting failures fail. Trying to keep failures afloat is one of the real problems why we're in this mess in the first place. But we can expect more of it. We can expect politicians to keep burying their heads in the sand. We didn't even get to discuss Social Security. Maybe that's time for another podcast. But yeah, the tailwinds of inflation are significant, even though that we have some deflationary forces here right now, and that's banks in trouble on commercial real estate and industrial loans.
Yeah, and I see larger problems for foreign banks that have that dollar-denominated debt and losses on the Treasury bonds because the Fed and the Treasury aren't going to have their backs like they do for American banks.
You got it. I think that's a wrap.